Well, good morning, everyone. My name is Jeff Peterson, and I am an attorney and proprietor of a company called Commercial Partners Exchange Company, also referred to as CPEC 1031. And for the last 26 years or so, I've been working in the area facilitating 1031 exchanges. And also I teach at a local law school here in the Twin Cities called Mitchell-Hamlin as an adjunct tax professor. And I've taught federal income tax there about 25, 26 times. So those are 4-credit semester classes. And so I know a lot about the tax code, but I really know a lot about my little lane, which is 1031, because I'm in the trenches every day, just humbly pounding out and administering 1031 exchanges in our capacity as a qualified intermediary. So we see these issues all the time. Now, this is a disclaimer. The information that we're going to be talking about is for pedagogical or educational purposes only. We're not going to be creating any attorney-client relationships. Everyone's situation is different. We're talking at a high level about big, broad topics. Anyone that's going to do a 1031 exchange should work with their own tax advisors and attorneys and so forth and get advice that's specific to their situation. So don't rely on this as legal advice. All right, so we're going to tell you what we're going to tell you, and then we're going to tell you it. So here's the big overview. I want to talk about the rationale behind 1031. Then I want to talk about the role of the qualified intermediary and touch on the napkin test, which is the general value, equity, and debt requirements for fully deferring an exchange, because that's going to inform our discussion about transactional expenses. And transactional expenses might be broken into two categories: those that are truly there because the transaction is occurring, like a brokerage commission would not be paid if the property were not sold, and other, what I might even call operational expenses, that are creeping into the settlement statement. And those are expenses that would have been incurred whether or not the sale transaction was taking place. And then I want to talk about boot and some workarounds for situations where gain may be being triggered. Okay, so that's the big overview. Now, when you're looking at a closing statement or you're preparing a closing statement, a lot of people gloss over the basic information. So let's talk about some of the basics. First thing that you want to do is make sure that we have the proper identity of the parties. If you're doing a sale and you're doing a 1031 exchange, oftentimes the identity of the seller is dressed up to reflect that the seller is the qualified intermediary acting on behalf of the taxpayer. The intermediary becomes the synthetic seller under the Treasury regulations and kind of becomes the surrogate that takes the proceeds from the sale. So if you're doing a 1031 exchange, either as buyer or seller, you may want to dress up the settlement statement to reflect that nuance. Now, a lot of things relate off of the date of closing, the day that the benefits and burdens of ownership shift. For example, we calculate the 45-day identification period. We also calculate the 180-day exchange period. And a lot of times people will prepare a settlement statement and then the transaction won't close on the day that it's planned to, but nobody changes the closing date on the settlement statement. Or maybe they have multiple dates. They have a closing date and then they don't disperse money until the next day because they missed their wire cutoff. Well, what is the closing date? The day that the buyer got their money, or the day that is printed on the settlement statement a day prior. So really honing in on the date of transfer and reflecting the date that the benefits and burdens of ownership shift, because that's important in a 1031, because all of these deadlines are going to be calculated off that. And if there's a discrepancy, let's resolve it. Another important detail is how much you sold the property for. In a 1031 exchange, if you're using the 200% rule for identification purposes, which is a ceiling that caps how much you can identify, knowing the consideration that was paid for the property, the relinquished property, is going to be critical, because you double that amount to get to your ceiling. So knowing what the amounts are involved in the transaction is very important. And if there's a change in purchase price, you need to reflect it on the settlement statement. And finally, I believe that the settlement statement should be signed by the parties. This is for the closing agent's benefit and everyone else's benefit, because their signature and date is going to ratify and confirm that they acquiesce to the numbers, the itemization of the expenses and so forth. Also, in my opinion, there is a requirement that notice be given to the other parties in a 1031 exchange that a taxpayer has assigned their rights in the sale contract to the intermediary, and as a final fallback, dressing up the settlement statement to show that someone is being accommodated by a 1031 facilitator, and having the other party sign that settlement statement further evidences that we weren't hiding the ball. We disclosed that the party doing the exchange was working with a qualified intermediary, and it's reflected on the top of the settlement statement.
Sorry, Jeff, my internet was out. We're up and rolling again.
Hey, Todd, good to see you. Todd and I have talked about 1031 exchange stuff for years. And, one thing that a lot of clients put the blinders on is they say, well, I've netted out $150,000 on my sale. All I have to do is reinvest my equity to go from orange to orange. And they don't think about the problem of having to continue their investment into properties of equivalent or greater value. And they definitely don't want to think about offsetting the debt relief that they enjoyed when they sold their old property. They're only fixated on redeploying the equity, the proceeds. And that can be a situation where they need to talk to their accountant and get coached up on what they need to do.
And get that in the closing statement, right, Jeff? I mean, when the accountant goes to fill out that 8824, they've got to check boxes. And if you can't provide them backup documents to exactly check those boxes, I think that's where a lot of people get into trouble. And then they fill out the form wrong. If that person wasn't a party to the closing, it's not a party to the closing statement. But for me, when I'm doing somebody's tax return, I want to see the closing statement before they ever close. So I'm calling Jeff Peterson. Hey, can you send me a copy? I know you're closing tomorrow. Send me a draft of that. And then I can make sure everything matches up like it's supposed to.
People should have their CPA or tax accountant on speed dial before the sale of the relinquished property and before the purchase of the replacement to review the settlement statements. Because if you drop it in your accountant's lap on April 15th of the following year, there's not much they can do to change how the settlement statement was prepared. Time to do that is before the closing is completed and consummated. Todd, a lot of people think that, well, when I bought this property years and years ago, I put $50,000 of my own money into the deal. When the sale takes place on the relinquished property, I should be able to get my original investment back. I should be able to get my $50,000 back tax-free, and then I'll just do a 1031 exchange on the gain.
Yeah, wow, like it's an opportunity zone or something.
Yeah,
Have you seen that?
And no, I mean, I think we have to educate the client that the first dollars off the table, the way you read the Treasury regulations and you read the code, is that the dollars off the table are the profit dollars, and the last dollars off the table are the return of basis, the return of your original seed money. So if you are going to take some non-1031 proceeds from the closing agent, it can be reflected on the settlement statement, but know that those first dollars off the table are all going to be taxable, and probably taxable at the highest rate that's applicable for that money.
That's a great point. And that's something that I see all the time, Jeff, is some kind of boot. There's three things that can happen with boot. You and I both know this, right? Number one is you can screw up your exchange. So that's the worst case scenario. There's certain boot triggers or types of boot that can just blow up the whole exchange and you're done. And then there's the second kind is I've got an offsetting, deduction to go with it. So we'll talk about that, right? But it's okay that I have a little bit of boot because other places on my tax return, I'm going to exactly offset that. Probably not the end of the world. But if I do it right, I can get the deduction and not have the offset. So let's do that one. And then the third one, like you said, Jeff, it's just taxable. You're going to have to pay some tax because you screwed up the closing statement or you didn't handle the exchange right.
So you guys might remember that we had the Starker case in the 70s, and then the service got Congress to authorize them to start writing some regulations for them to constrain and put some guardrails up around 1031. And in the 80s, the implementation of the 45-day and 180-day exchange period, these are guardrails that came up, and it's important to know your closing date, the date that the benefits and burdens of ownership shifted, because your 45-day identification period tracks off of that date. And a lot of times I see settlement statements where the print date and the close date and the disbursement date are all different, and we don't know what is the date of closing. And then you've got some people that just do things really weird, and they close in very unconventional ways. And that makes it really hard to know when the benefits and burdens of ownership shifted and to know how to track your 45-day date. So on your settlement statement, for the mercy of the accountant and the intermediary and those involved, I would say really try to emphasize the correct date of transfer at the top of your settlement statement. All right, here is just a nice linear line. Shows that after the,
for 1 second, Jeff?
go ahead.
I don't think people always realize there are 4 dates on the 8824, right? I'm going to pull one up. I'll let you keep going, and then I'm going to pull up an 8824 here in a second. I'm going to tell you what those 4 dates you should have on your closing statement. So hold tight or keep going.
You bet. So in this little linear diagram, the thing that's really interesting is that the day of closing, the day that the benefits and burdens of ownership shift, that's day 0. You don't count that day for calculating the 45-day and 180-day time frame. And you can see that both of those clocks are running concurrently from the day after closing. So it's not like you get 45 days and then you get another 180. They run together. And the curveball that the IRS threw at people, the trap for the unwary, is that you may not get your full 180 if your deadline for filing your federal income tax return pops up within that 180-day period. So let's say that you started your exchange late in the year, in let's say December, and you file on April 15th, you may not get your full 180 unless you extend your federal filing deadline. You can extend your federal filing deadline, but you can't extend your 180-day period, generally speaking, unless it's like a federal disaster or something like that. All right, so big purpose. If you go back and you look at the legislative intent around the time of the first iteration of 1031, one of the purposes was to not penalize people when they're not cashing out. They're just continuing their investment in other similar property. And since they're not cashing out, they shouldn't have to recognize the gain. For example, let's say that Todd is a farmer and he continuously owns the same plot of land for 50 years. I'm also a farmer, but because of some disruption and development or whatever, I had to sell my original farm and then continue my farming in another location just down the road of similar size and so forth. Because I had a disruption, I had to sell my original farm and purchase a different farm. One of the purposes of 1031 is to not penalize me as long as I'm not cashing out, because I just continued my investment in a different property. Okay. Not cashing out is a big rationale. If you're cashing out, then that rationale falls off and you should have to recognize the gain. Okay. And you're considered to be cashing out if you are the puppet master and have either constructive receipt or control of the funds or actual holding of the money. So that is something that's important. In a modern day 1031, you typically hire a qualified intermediary under one of the safe harbors for facilitating exchanges to hold your proceeds. You're basically paying the intermediary to insulate you from having actual or constructive receipt of those funds, control of those funds. Here is the language of the original precursor or version of 1031 from back in 1921. And it's interesting, Todd, because this was enacted right after World War I. And during World War I, to pay for that war, we had tax rates as high as 73%. And Congress made a decision after the war that they were going to goose up the economy and expand the economy. So they were lowering taxes and they were creating basically things in the code to make the economy go faster. And you know, I think that we need to know that context as well, that the precursor of 1031 was enacted as part of a post-wartime effort to try to make the economy go faster and bolster the economy.
Wouldn't it be fun to be back in the day and have had these discussions? But I think what would have happened was it takes so much capital to buy land and produce a farm, or to buy a business and produce a business, that if you were going to disrupt that, like you said, and have to pay the taxes and at these crazy tax rates, right? You would never get the capital again to be able to restart that farming business. It's interesting that we've morphed it into, this is much more of an investment tool than a business operations tool. But Jeff, you know, you probably see, I tend to just see the investment stuff. You probably see people that are actively running a business that are 1031 in one location to another, whether that's a farm, and you and I have talked about hog barns and all kinds of crazy assets that are out there. So don't forget, some of these are businesses, even though a lot of people online might be investment real estate focused.
Well, you know, at the bottom of the screen, it says that this early iteration was intended to promote transfers, to prevent the lock-in effect, you know, and without having this valve in the tax code, people just won't sell. Farmers won't sell. Apartment building owners will say, there's no reason to go from good to great if I have to give away a third of my hard-earned equity. I'm not going to aspire to get bigger. I'm just going to stay in my little small apartment building because that's what I am basically incentivized to do. Because if I take any risk to go bigger, I'm going to have to pay a lot of money in taxes.
I feel like a broken record, but maybe January 1, Jeff, we should just show up at every Congress, you know, just whatever the first day is. I don't even really start mid-January, right? Just give the speech, remind everybody why you have 1031, that it makes you tax revenue instead of hurts you. And let's not have this discussion any further. The rest of the next 12 months, we'll be back next year.
Absolutely.
Jeff, do you have a slide on what makes a good QI? Because you brought up QI on the last slide.
You know, I don't know that I've got a self-promoting slide on what makes a good QI, but
Let me do two
Like-
things because
yeah, sure, sure.
you
Yeah, go ahead.
skipped over some stuff I wanted to. Number one, you know, when you said you use a QI, I've seen it dozens of times. People try to use something other than like a professional QI that holds themselves out to be a QI. So you could, can you use an attorney? Technically, yes, you can't use your attorney. All of these little things like that are going to blow up your exchange. They're going to cause you to pay 100% tax. And if you've already completed the exchange and didn't know that, now you have the property, no money, no cash to pay the tax, and you owe the tax. IRS doesn't care. So this is probably the most important part of this, is because we're talking today about about the closing statements. Your QI is the person who's going to be the consultative, collaborative person to work with you to get that right. And so I know you don't have a shameless plug in here, but I wanted to get it on record that Jeff Peterson as a QI is that guy who's going to help you through the nuances that your accountant may not even know. Because I see that too. CPAs that maybe fill out the 8824 once every couple of years, and they're not thinking about it. I had to look it up. I had to bring it up so that I could put it on my screen. Jeff, can I screen share just a second?
Sure. I'm going to stop my share.
Just things like this. Where is my? Make sure I got it. Let's see.
Well, you're doing that. I'm just going to mention,
Okay, go ahead.
if you use a disqualified person to be your qualified intermediary, the presumption is that the exchange is blown, because you're supposed to use someone that is neutral and unbeholden to you. If you're using your attorney to act as your qualified intermediary, and that attorney has provided you legal services in the last 2 years, or someone that's because of the rules of attribution, and the firm has provided you legal services, you could blow your whole exchange. So first and foremost, I think it's a good idea to have a representation and warranty from the party acting as your intermediary that they're not a disqualified person. But even more importantly, don't use a disqualified person to act as your intermediary. The fees are relatively nominal. Go and use a professional, independent intermediary company. That's what they do. Don't use your own attorney or your own accountant or your girlfriend or whatever. Use someone that's neutral and unbeholden to you.
And I bet we could talk all day about how you could lose your money, giving your money to the wrong person. We saw that last recession. All right, sorry. Jeff and I go in different directions. I hope that's okay with everybody. But back up to 2 slides ago, Jeff mentioned the dates, having them on the closing statement. So you've got 2 closing statements, one on the property you sold, one on the property you bought. Your CPA or accountant or whoever does your tax return is going to want these 4 days. And if they are on a statement, you've made their lives much easier. Not only just they can fill out the form much faster and cheaper for you, but also if you ever get audited, the IRS agent can just boom, 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 and check these dates off. So this form is available for anybody at any time to look at. I would recommend as an exchanger, just peek at the instructions for the form. What questions are going to be asked when I report this thing? So
it's nice to be able to look at the form, because it's almost like you're looking at your transaction in the rear view mirror, and you're understanding what important pieces of information are going to be necessary to give to your accountant. All right. Do you want me to resume the slides here?
Yeah, go for it.
All right. Let me see if I can share my screen again here. So
the first CE question was asked. So just make sure that if you're here for CE, that you're answering that first question. Chris and Catherine, I didn't see you guys answer it. Thank you.
Thanks, Caitlin.
So here is Congressman Green from Iowa around the time of the first iteration of 1031's passing. And he's talking about if the property is reduced to cash and there's a gain, of course, it will be taxed. So he's talking about make sure that you don't reduce it to cash. Cash is not a good thing. like-kind property being received is probably preferential than cash if you want to defer your gains. All right, here is a case that is pre-1991. So it's before the safe harbors for qualified intermediaries and qualified escrow agents and so forth existed. But in this case, the taxpayer used a quasi-intermediary. Unfortunately, the taxpayer was still the puppet master. In the Florida case, the taxpayer was really using a patsy. The taxpayer was writing out the checks for his old friend and attorney to sign in the capacity of the exchange escrow agent. When extra monies were sent off for a closing and there was additional funds that should have come back to the 1031 escrow agent, those funds didn't come back. They didn't really adhere to the terms of their own escrow agreement. They were just playing fast and loose, too loose. So loose that the IRS basically said this exchange failed. So the takeaways here are, don't use a patsy or disqualified person to be your intermediary. Adhere to the terms of your exchange agreement and don't play fast and loose. And if there's extra money that goes off to a closing, have it returned to the intermediary. Don't just give it to the taxpayer that's supposedly being insulated from receipt of any of their proceeds. So adhere to the terms of your exchange agreement and the general rationale and basis behind 1031, which is to insulate you from receiving your funds. All right, couple Treasury regulations that back that up. The current regulations that were issued in 1991 are designed so that the taxpayer is not considered to be in receipt of the proceeds. The fiction is that the intermediary insulates the taxpayer from receiving anything but like-kind property if the exchange is done 100% correctly and efficiently. The intermediary holds the money, but that holding of the money has to be pursuant to a written exchange agreement signed by the taxpayer and the intermediary. And that exchange agreement has to contain limitations, what are sometimes referred to as the G6 limitations. The G6 limitations are the modern iteration of the idea that you can't get your hands on the funds. You can't have any benefit of the funds while they're being held by the intermediary. And then there's another fiction, and that is the direct deeding fiction. If the qualified intermediary is the seller of the relinquished property, olden days, back in the olden days, pre-91, you may have deeded your relinquished property to your qualified intermediary acting as your escrow agent, and the escrow agent would have sold the relinquished property directly to the buyer by deed. That extra deeding was unnecessary and quite burdensome. So in the 91 regulations, they came out with this idea of direct deeding, where there would simply be a deed from the taxpayer conveying the relinquished property to their buyer like they would normally do, but there will have been an assignment to the intermediary of the taxpayer or seller's rights in the relinquished property sale contract to the intermediary. And that assignment wasn't considered effective unless there was written notice given to the other parties. The other parties being the buyer, the relinquished property, or theoretically the seller of the replacement property. So when we say we want to identify the names of the parties on the settlement statement and do it correctly, and further dress up that the intermediary is acting on behalf of either the buyer or the seller, we're trying to further comply with this Treasury regulation that was issued in 1991. Okay. The intermediary is going to be treated as the qualified intermediary pursuant to this agreement if that exchange agreement contains the G6 limitations. And that basically says you can't have any rights to receive, pledge, borrow, or otherwise get the benefits of the money. And that exchange agreement is voided, doesn't work, the moment that that G6 limitation ceases to apply. So you don't want to have an agreement and then not follow it like they did in the Florida case. That would be contrary to the requirement that you have to continue to keep this wall up to prevent the taxpayer from having the rights to receive, pledge, borrow, or otherwise obtain the money. So you got to adhere to the terms of your original exchange agreement to make the exchange work. All right. And then we talked about your intermediary can't be a disqualified person, supposed to be a neutral, unbeholden person. The QI can't be the taxpayer's employee, attorney, accountant, investment banker, or broker, or real estate agent, relative, if that person has provided basically services to the taxpayer within the last 2 years before the date of the relinquished closing. So can't go back to your attorney. If your attorney has just represented you in a DWI and done some estate planning for you, they can't also be your qualified intermediary. They're locked out for 2 years.
Worse yet, the attorney on the transaction, right?
Yeah.
Well, Jeff, just for context, for people who aren't attorneys, we asked in our first question, what's your role? For the people watching, and I assume people watching on YouTube is going to be a similar demographics. We've got brokers, investors, developers. Probably don't have any attorneys. When you say things like G6 or G3 or G5, or you're talking about treasury regs, or if something I see on the screen starts with 1.1031. So just for the uninitiated, law starts at Congress. There's no one dot in front of it. That's a codified law. And there is no arguing with that law ever under any circumstances. And then they give broad authority to the IRS or to the United States Treasury to then interpret that. And they have to do that in writing. And that's a Treasury regulation. So when I used to work in a tax think tank, we would start with what's the law. You would read 1031, beginning to end. It's shorter. Then you would pick up this gigantic book of regulations and read 1.1031. And that's the Bible that somebody like Jeff lives by for the stuff we're talking about today. Is inside that Bible. Over the last 100 years, they have refined these regulations, right, Jeff? In some cases, it's nice. It's very well laid out. And if you go into the regs and into the examples and you're selling this type of property, it's there. It will tell you this is how you treat this type of a transaction. Now that's usually something out of case law or a 1 in 1,000 deal. But so then Treasury, then there's other authority out there. Like somebody wrote something on the internet. And you say, well, I relied on, this XYZ.com has information about 1031s because everybody and their brother has that on the internet, right? That information is not authority. You cannot cite that and say, this is why I did my transaction this way. You're in trouble at that point. So I just wanted to make sure to lay down that context. The reason Jeff puts in this slide you're looking at right now, G3 to G5, is because now we're talking about exactly what the IRS says. This is the law and these are the rules we follow. Sorry for going off on a tangent.
Yeah, you bet. The Internal Revenue Service and the Treasury, they have the obligation to administer the income tax collection. And so they have to issue regulations to help people understand how they're going to interpret the code and apply the code. So if you see a 1 and a decimal point and then like 1031, you're reading a Treasury regulation, not the code itself. But the authoritative level of the regs, once they're issued and they're finalized, they're pretty much gospel. They're almost as authoritative as the code. Now, we've talked about G6. G6 says you can't have any rights to receive, pledge, borrow the money that is held by the intermediary. When the sale of the relinquished property occurs, the money goes basically into a QI containment chamber. The QI holds that money so that you don't get to touch it, smell it, hypothecate it. But then we have to deal with the transactional expenses involved in the sale and the purchase. And G7 is kind of an exception to G6. And it says, you know what? We know that all of your equity from the sale of your relinquished property, all of your proceeds should be, in theory, reapplied to acquire the replacement property. But reality is you don't get all of your proceeds because some of your proceeds may be siphoned off to pay the real estate commissions and the state deed tax and the recording fees. And then on the purchase of the replacement property, again, there may be settlement charges and fees. And so there's going to be some siphoning of the funds to pay transactional costs. And G7 basically says you can pay some of the fees that would be appearing on the settlement statement under local standards. And then they give an example under the purple here, i.e. commissions, prorated taxes, recording and transfer fees, and title fees. That's right in the regs. It says you can pay those without jeopardizing the entire exchange. You're not going to blow up the entire exchange.
I'm glad you made that in pink. So this is one I saw this year, 2023, where this stuff was on the closing statement. And in this instance, there was a lot of it. Every box you're going to hit, Jeff, in your PowerPoint slide, I think they had. It was a 2-page closing statement. Everything was there. Everything imaginable with this property that you could think of was there. It's like a case study. And it was all in the closing statement. And the attorney said it didn't blow up the exchange. Now, you're technically correct, but you now have a very, very unhappy client. I'll let you continue.
Because yes, you can pay operational expenses like property taxes here, the prorated tax at the bottom, your taxes, the ad valorem taxes that you pay on your property, you're going to pay them whether you sold the property or not. That tax bill is coming. And it creeps into the settlement statement because you got to settle up between the buyer and seller and prorate. Here's the seller's share of the money for the portion of the time that they own the property. And then going forward, the buyer's going to pay their property taxes. But it creeps into the settlement statement, and siphoning off your 1031 proceeds to pay that operational expense of ownership is going to trigger gain, because you took some of your cash equity from the sale of the relinquished property and you didn't reinvest it into the replacement property. Instead, you used it to pay for a non-qualified expense, an operational expense. Throw the ball to Todd now. What would be a better way to deal with that?
Right. Well, and I alluded to it earlier. The first bad thing is you blow up the exchange. So Jeff's saying, okay, if you're in section, what is this, K? Here's some exceptions. You're not going to blow up your exchange. Then there's 2 things within this. Number one is it has an offsetting deduction. So if you had prorated taxes and on your 8824, you're going to trigger gain. And as a taxpayer, freak out, right? Oh my God, I just triggered gain. What's wrong? And then someplace else on your tax return, you're going to get a deduction that offsets that. So the net effect, it's 0. Probably nobody cares. The accountant may not even tell you. Might just be like, yeah, right, you're fine. But there are other ones where there's no offsetting deduction. Now you're writing out an actual check. The ones with an offsetting deduction, you can actually double dip if you do this right. So I think that's the purpose of this whole webinar, Jeff. Right? We've got. Well, we can go a little bit over time.
Well, let's give an example of one that wouldn't have a corresponding deduction, and that would probably be like security deposits. You're supposedly holding these security deposits for your tenants in some, escrow account somewhere. At the time of the closing, you should give those security deposits to the buyer so that they can hold the tenant's security deposits. But if instead you siphon money out of the sale of your relinquished property to pay those security deposits, what's going to happen is you're going to recognize gain to the extent that you took that money out of the exchange, and there's no offsetting deduction for security deposits.
So
that's going to make, yeah,
right,
but
$1,000 probably no big deal. But remember, it's all taxed, right? So I hear people say this all the time. If I sold the property for $1 million and I had $750,000 of basis, 25% of my sale price is gain. And so therefore of the boot I receive, only 25% should be taxed, right? And that's not true. They start at the top and they take it off the top. And they start, like Jeff said, with the highest possible tax rate. So if you have a recapture, if you have personal property, we'll get to personal property too, right? There's some things in there that could be at 45% combined federal and state, or it could be just capital gains. Either way, it's coming right off the top, and 100% of that security deposit amount is taxable to you.
So I work with a small subset of super conservative tax attorneys, and they tell their clients, we're paying all of the transactional expenses out of pocket. They want to get in and out of an audit as narrowly as possible and not give a revenue agent anything to hang their hat on. So they just pay every transactional expense out of pocket. They send in a wire transfer to the settlement agent that appears as a credit on the closing statement, and they basically fund all of the transactional expenses out of pocket because they don't want to have an argument over a trivial item that, you know, could have triggered boot or not triggered boot. They just want to get in and out clean. And that might be an overreaction, but I personally think it's a good idea to pay anything out of pocket. If your client has the money and the ability to do so, pay the security deposits, pay the prorations of rents, and anything that would trigger gain that doesn't have a corresponding deduction, pay it out of pocket, and maybe even pay the other items out of pocket as well.
Jeff, I try to get them even on a separate part of the closing statement, like a peer seller's closing statement or something. And some closing agents don't do that. Like everything's on one page, live with it. But if you can even group them together, right? But you brought up a great point, and that's one of the reasons I formed Providence, because you can do all these tax strategies. And if you watch enough YouTube videos, probably 80% of the things that are in my head are out on YouTube somewhere. But if you don't document it correctly, you are leaving yourself open to an audit, and the IRS gets it. So if you're going to do something like employ your kids or take a home office deduction and you don't have the proper documentation for it, that's what they're looking for in an audit. So an IRS agent's sitting working from home and they're going through tax returns and they're looking for the knucklehead who did a 1031 exchange, who doesn't have things documented well, right? That's what they're looking for. So now it's an opportunity for them to audit. So your attorneys are smart, Jeff, that you're working with, because they're saying, if you pick my client for audit, I'm going to send you so much and so well documented paperwork that it becomes a mail-in audit and we can get rid of it in 2 days, right? I'm exaggerating for effect. It doesn't take 2 days, but nonetheless, they're not coming to your house. They're not looking through your documents. They're not looking through shoe boxes or receipts, and they're not asking for your bank statements because you've got things so well documented.
Transitioning to other property. In a 1031 exchange, you have to buy like-kind property, real estate. So let's say you sold an apartment building and you bought a bigger apartment building. Everything's fine, right? Real estate to real estate. Well, what if some of your 1031 funds are being used to pay for the incidental personal property that goes along with the apartment building? Maybe there's window air conditioners or tools, lawnmowers, stuff that's not real estate that's thrown in with the deal and would customarily be sold with the apartment building. There's two things going on here. One is the identification rules. You got to identify the replacement property. And if you're getting some incidental, insufficient items, not significant items along with it, do you have to identify those items? Well, the rule is that as long as those incidental items that are coming along for the ride don't amount to more than 15% of the real estate that you're identifying, then you don't have to worry about it from an identification point of view, but from a G7, G6 limitation perspective, you also don't have to worry about it, provided you don't have so much personal property that it exceeds 15% of the real estate. And now notice I'm saying 15% of the real estate, not 15% of the total deal. I'm only saying 15% of the like-kind real estate. So you got to be careful. This is a trap for the unwary. where there's incidental personal property involved in the transaction. Now, pro tip, if you're getting used air conditioners and a used lawnmower and some other equipment and maybe some other appliances, the IRS will generally respect a negotiated and written allocation of value between the parties. And maybe you, as the person doing the exchange, wants to allocate formally that all of this lawnmowers and air conditioners and used equipment is going to be sold to you at garage sale prices. And maybe you want to pay for it out of pocket, just out of an abundance of caution, so that when you get that bill of sale for the lawnmower and the air conditioner units, you've paid the seller out of pocket for that and not potentially complicated your exchange by siphoning 1031 proceeds for the incidental personal property.
Now,
And
personal property exchanges, Jeff, used to be a thing, right?
We used to love doing exchanges of airplanes and tugboats and other business equipment that had a long maker's life, like railroad cars were fun. But here, what we're trying to do is we're trying to dress up the settlement statement to remove ambiguity and create certainty. And if I have a lawnmower and air conditioners and other equipment and appliances that I'm receiving, I would like to have a line item on the settlement statement that shows that those were paid for pursuant to the bill of sale and pursuant to the purchase agreement X. And furthermore, I would like that to be paid outside of closing, POC, where the taxpayer writes a check to the seller out of their own pocket or wire transfers money to the closing agent specifically for that purchase. And let's not muddle up our 1031 by utilizing exchange funds to pay for the incidental personal property. That's a conservative approach, but let's be conservative. Let's try to get in and out of audits as narrowly as possible when we can.
Let's do a real life one here quick, Jeff, if we can. So back up to that slide just for one more second. Well, you and I just closed the transaction on behalf of a client for hotel, where the replacement property is a hotel, and that's very real. There's a lot of personal property in a hotel. And depending on whether you do a cost segregation study or not, you may identify a lot of them. So what a different client asked me about, should I be trading up, as I go forward in my 1031? So the old model, not the old model, one of the ways to build wealth with real estate is to continue to 1031. What's the saying, Jeff? 1031, 1031.
Defer, die.
Right. And that's just an oversimplification. But as you go through this progress, trading up cures a lot of these problems. So if I'm going from whatever it is into a hotel, I've got potential things I should be thinking about, trigger issues. To the extent that you can trade up, like take on more debt than on your relinquished property, put cash into the deal to cover these things, whatever that may be. Trading up is a good thing, not only from a tax perspective, because it gives you some cushion for room for error, but it also is going to build wealth, right? It's not a horrible idea to do to begin with. So it's okay to put money into your exchange and think about it that way. And you're reinvesting, you're building whatever it is, but you've also given yourself a cushion for that.
I agree. Go big or don't go home, whatever the expression is. Some people are exchanging just to get into a different geographic area, and they're fine to do a lateral exchange. But I think most capitalists want to stretch their equity as far as possible and lever up into a bigger, better property, get more property under their control. But the purpose of this seminar is to talk about closing statements and things that we can do on the settlement statement to help validate and inform the CPA that's going to be reporting this on the form 8824, what needs to be included in that disclosure. And I like the idea of paying certain transactional costs out of pocket, even though they technically can be paid out of sales proceeds or exchange funds. I just like to keep it clean, but reasonable people can differ about that. Not everybody wants to do a full 100% 1031 exchange. And Todd was alluding to this earlier. If you want to take boot, if you want to take some taxable proceeds And 1031 is not a zero-sum game. You can do a partial 1031. I think the time to take your cash, if you know that you want $50,000 or whatever the amount is, you amend the exchange documents, you amend the closing instructions to the closing agent, and then on the settlement statement, you have the settlement agent, the title company or escrow officer, send the boot to the taxpayer before the rest of the net proceeds are sent to the intermediary. But once the intermediary gets the proceeds, you can't put your hand in the cookie jar and get the cash back. So the time for you to receive the boot is when the settlement statement's still in control of the proceeds, and take the boot at the beginning if you know what you want. Or alternatively, if you're not sure how much boot you want to take, you could ride out the whole exchange period. And at the end of the exchange, when the exchange period has ended, you could get your unutilized extra remaining surplus exchange funds back from the intermediary as taxable boot at the end. So if you're not sure how much you're going to need to spend, you may want to hold off and take the boot at the end.
Yeah, I like you brought that up. And it's, again, I'm nerdy here. I'm thinking about the 8824, but there's a line on the 8824 that says fair market value boot received. If it's on a closing statement, you just made everyone's lives a lot easier, and you're not opening yourself up for audit.
So here's some items that you typically don't want to pay out of the 1031 proceeds because they will likely trigger some gain. Now, they may have offsetting deductions that will mitigate the hit, but just food for thought: prorated rents. Is that a problem if they pay the prorated rents? And is there a corresponding deduction for that? I don't think so.
Right. This is the list. Was the genesis of doing this webinar in particular. So if you're watching right now, take a screenshot. Jeff and I can send you these slides too. If you have an email address for me, I'll put it in there, or Caitlin or anybody will get you these slides. But this slide, and I think Jeff, you've got one more, that are things that I would save if I'm doing a 1031 exchange and look at this stuff. Better yet, send it to me or Jeff before you close the draft of the closing statement. But here they are. These are the items, right? So your question was, do you want to go through each one, Jeff? Do you want to go through?
Well, I'm just gonna hit two that are kind of problematic for people. Let's say that you own a duplex and it's in rough shape and you have to go in and put some new paint and linoleum in and do some repairs and maintenance to make it pretty for sale. Repair expenses are an operational expense, not a marketing expense, generally speaking. So I'm not sure that you can recoup on the settlement statement your outlays that you made to maintain and gussy up the property, put the lipstick on it. But some sellers feel like, well, I wouldn't have spruced it up if I wasn't marketing it for sale, so I should be able to recoup my outlay. What do you think about that, Todd?
Well, you're going to probably have a Schedule E for this rental property, or a partnership return of some kind, an LLC or something like that. And that is going to have expenses for repairs and maintenance on it. And you can put those on, you can put that on here, but you're missing the chance. There's very few chances in the tax code in 2023. It's very complicated. And usually the taxpayer loses on just about every instance of things. But here's a chance where you can actually do a little bit of double dipping, right? You can still get that expense if you pay it, but pay it on the closing statement, pay it into the QI. You'll get the expense and you won't have the boot to recognize as gain.
So if it's a repair, you would probably lean towards paying it out of exchange funds and then take a repair deduction?
Always.
And what if it's a capital improvement? Would that change your?
Yeah, that's a great question. So there's always this thing is, am I replacing an entire HVAC unit? Is much different than I had a repairman come and replace a circuit or something like that within it. When you add to the basis of a property by improving the property, or, adding a new HVAC unit, adding a new roof, adding a new parking lot, those things are capital. And there's no offsetting deduction for that, right? You would increase your basis. So if you're talking about a sale, like a sale for cash, it's not going to affect things. But when you're talking about a 1031, you got now you got one of those where you're going to get double whammy, and it's an ouch.
Another item that a lot of people think that they should be able to pay out of 1031 funds are the costs associated with getting your new loan. But the IRS strangely looks at this loan, this financing arrangement that you have with the bank, as a distinct and separate asset. It's kind of like a sidecar that's attached to the real estate. And you write off the cost of the loan over the life of the loan, not over the depreciation schedule of the real estate. So it's like this loan is a separate asset. And then that asset's not a real estate asset. That's like a financing asset. So when you need to pay a rate lock fee or a loan underwriting fee or whatever the lender's fees are, those are items that you may want to pay for out of pocket and not siphon your 1031 proceeds to pay for. Even though G7 might indicate that you could pay it, it's still maybe one of those things that you don't want to pay for with your exchange funds. What do you think about that, Todd?
Amen. Yeah, you can pay it and not blow up your exchange. That number one that I was talking about, the nightmare scenario. There's boot items out there that can ruin everything for you. This isn't one of them. But yeah, so let's just walk through the two scenarios.
And I want to talk about timing. You
Yeah.
can pay it on the settlement statement if it's a transactional item that would routinely be seen in that area and so forth. The problem with some of these loan fees is the lender wants their money early. It's like before you've even scheduled the closing for the replacement property, they want some kind of fee. And I don't think that the intermediary should be paying loan deposits out of the exchange funds. That's an item, in my opinion, that should be fronted out of their own pocket, because I think it could jeopardize the whole exchange. Now, you could pay a loan related fee on the settlement statement at the time of closing. So timing of when they want this also may affect the answer.
Yeah, amen to that. But if it gets paid on the closing statement, you're going to have boot, then you're going to have an offsetting deduction over 10 years if it's a 10-year loan. You don't want that. It is at the end of the world if you don't have the cash. You and I, Jeff, talk about real estate people. A lot of us cash, balance sheet rich, cash poor. When you get to a closing and you have to write out a bunch of checks to cover all these things, it's not what you expected to do when you closed a property. So you're scrambling for cash potentially. There are things we can coach you, but there are things where it's like, well, you know, that's kind of bad, but here's the one that's really bad. Let's make sure we get that. And loan fees is somewhere in the middle.
Here's a list of the things that I think are probably okay to pay as long as they relate to the specific exchange or exchange transaction. So attorney's fees, if they're related to the transaction, but if you owe your attorney also for other fees, maybe they did some estate planning, maybe they did some criminal defense work for you, you know, those unrelated attorney's fees shouldn't be put on the settlement statement because they're not related to the transaction. Same thing with your tax advisor, financial planner fees. As long as they relate to the transaction, I think they're permissible. Title insurance premium for the owner's policy, I think is A-OK. But the expense for the lender's policy, if that might be considered a loan related expense, just like mortgage registration tax may be a lender related government filing fee. So you may want to really parse down and look at each and every item on the settlement statement and see if it's a qualified expense or unqualified expense, see which one of these categories it falls in. Or if you just want to be really careful, just pay everything out of pocket if you have the cash to do so.
Jeff, I got to do a housekeeping item real quick. We are if you logged in this morning and you're not watching this on YouTube and you're here to get continuing education, you can log out right at 9 o'clock. But we're asking that you put your name and your license number in the chat room. Everybody else stay on. If you have to log off because you have a 9 o'clock call, the rest of this webinar will be on YouTube here in a week or so. So reach out and I'll make sure I can get you a link to that. All right, you can keep moving, Jeff.
Super. Next item I want to talk about is logistics. If you have some boot items that are on the settlement statement that you clearly don't want to pay for with 1031 proceeds. The first thing that you want to look for is, do I already have some of my own money in the transaction that I can apply towards that? So if there was an earnest money deposit that you ponied up for the replacement property, you can earmark a portion or all of your earnest money deposit to be paying for the boot items. You could use an asterisk, or you could make a notation. You can annotate that settlement statement to do so. Also, you might be getting some credits from the other side. Maybe the seller has agreed to give you a $10,000 amount for something, a concession of some kind. You could apply that credit that you're getting from the other side. And then lastly, if you have boot items that you don't have any way to find any money on the settlement statement to earmark, you can send in outside money. Send in your 1031 funds from the intermediary, and then send in non-1031 monies out of your own pocket. The closing agent needs to know that you intend to send in extra money to pay for these items, and they should notate that on the settlement statement that they received this money, show a credit on the settlement statement.
Jeff, let me ask two things on this. Number one, just a statement. My staff, when they're filling out 8824, the first place they look is seller credits if they see boot items, right? So that's, make sure they're annotated and on there, and there's clear that this is a credit from the seller. Number two, what about after closing? So somebody sold a relinquished property, it had a bunch of boot trigger items on it, whoops. And they call up their CPA and they say, I think we screwed this up, but it's already closed. Can somebody wire you the money later after the fact, and then that gets held in escrow and applies to the replacement property?
I don't think that you can add cash after you've received cash boot. So once you've gotten the cash, I think you got a problem, which differs from like debt relief can be offset by cash added later, but I don't think you can add the cash later. The time to fix this is before the settlement statement. They should have consulted with their CPA and sent the closing statement to the accountant early before the funding of the closing so that they could add cash to cover these items if that's what the CPA recommends.
Amen.
All right. Seller back financing. Wow, big topic right here at the end. I'm just going to say, if you want your 1031 to be clean and simple, avoid seller back financing on the sale of your relinquished property. If you receive a note or promissory note or IOU from the buyer, that is going to be boot. That's non-cash paper that you're receiving. There are workarounds where you can have the note run in favor of the qualified intermediary, and then later have the qualified intermediary sell that note for cash to get all cash in the exchange account. But the conservative play here is to run the note to the intermediary so that the intermediary is receiving all of the cash proceeds and all of the non-cash proceeds, so we don't jeopardize the exchange. That's the conservative play. But the even more conservative play is don't do seller back financing. Don't sell on a contract for deed, and also try to do a 1031 if you can help it.
One of my favorite moments of the year, Jeff Peterson, was earlier this year. You and I are on the phone with two other very smart attorneys, I believe, because I remember the Hollywood Squares on Zoom. And this was a transaction that involved just about everything we've talked about today. And I remember staring at the screen, hoping someone would talk, because we're all processing this, trying to figure out how to do, and the seller financing and the personal property, like, holy cow, you can get a lot of hurdles in here. But we did finally come to a solution that it was brilliant at the end of the day. But that was, we took, in this case, in the seller financing, we took that out of the deal and made it a separate deal. So, and this was the kind of property where that was easier to sort of delineate. You didn't have to go back and, do tenants in common or change the title or anything like that. But, this is an area where I think you have to get pretty creative, because there's no easy button for seller financing in a 1031 environment. So if you can avoid it, avoid it. And the other piece of that transaction, we recorded a mortgage, right? So there was a mortgage in there.
You know, twice in my career, we've received seller back notes from the buyer of the relinquished property and have been able to allonge or give that promissory note, that IOU, to the seller of the replacement property. So we gave the seller all of our exchange funds, and we gave the seller these promissory notes, the IOUs from the buyers of the relinquished property, as partial consideration. If you can believe it, they actually took the notes as well as the cash. That's a very rare situation, but it happens from time to time.
It's probably not that bad of a deal though, right? If you've got good credit on the other side and you've got a transaction that, you know, looks and smells good, that person probably then had an installment sale, right? So they had decent tax treatment that may work in their favor at a later time. So I don't know. Yeah, it's unbelievable, but at the same time, that's a very creative quality solution.
All right, well, here's some final thoughts and some practice tips. In the settlement statement, I think that you should use this document as your big CYA. Have the parties sign it and ratify their approval, but spell everything out so that it's clear as day. Make the job of the accountant easy by itemizing everything in detail. And when possible, have the taxpayer, the exchange, or bring in cash to cover those items that they can, like the operational items. The best example I can think of are the prorated rents and the security deposits. Those are the big ones. But there are cash poor taxpayers, people that have great balance sheets, but not a lot of liquidity. And my fear is that they will have selective amnesia when they get the tax bill and realize that they are going to be taxed on the security deposits that they pocketed, or the prorated rents that they collected for the entire month, but then kept in their operating account. So, you know, emphasize it to your client and let them know this may trigger gain, and you may have a little tax hit to the extent that you've siphoned off some of your exchange funds to pay these non-qualified expenses. Because they will forget, and then they will also point the finger, and that's always uncomfortable.
I've never seen that. That's sarcasm for those of you who can't see my face right now.
And then Todd, you love to talk about the calculation of gain and going in with eyes wide open, because they will treat every dollar that's peeled off the top as boot, and they will apply the highest rate of taxation first. So it can be costly to take some cash off the top.
Yeah, I think it's totally unexpected, right? That's the thing that gets people is, you know, you're looking at your tax bill on April 15th or whenever you file your tax return, and whoops, how did I owe more than I thought? It's the worst feeling in the world. Last fall, my wife and I were going to do a Caribbean or tropical vacation, right? And I had miscalculated how much we owed. I didn't account for some of these add backs that happened in the 2017 Jobs Act. And you know, shame on me. I'm supposed to be the smart one in the room, but had to write out an extra check. And I was like, well, that's kind of the money that we plan on going on that Caribbean vacation with. So it can have emotion tied to it, right? That's why it's so important to have these discussions up front, because you can get really, really frustrated with taxes if you don't plan properly. So maybe that's why I bring it up all too often, Jeff. But yeah, definitely calculate that gain on the closing statement. Show, you know, make sure you know what this is going to cost you.
A savvy CPA or tax attorney might recommend that they reinvest all of their equity and do a super clean 1031, because later in a subsequent transaction, the taxpayer could refinance the replacement property or get a HELOC or revolving line of credit, whatever you want to call it, to access their equity later and take the money out tax-free post-exchange. Because when you borrow money and you have a corresponding obligation to repay that loan, it's not income. And so you can get your hands on the same amount of cash if you're patient and you delay your gratification. So, you know, there are workarounds. I'm worried about rate lock deposits. I don't like to pay them, and I generally don't pay those out of exchange funds. There are situations where you've got some oddball expenses on the settlement statement that nobody really knows how to deal with, and it may require reading the loan documents or the item that creates the obligation to pay it. But prepayment penalties on loans and mortgages, ideally that prepayment penalty is going to be treated as additional debt owed to the lender. And then that debt can be offset with new debt taken out in conjunction with the replacement property. But you may need to read your loan documents to know that that's a justifiable position. Worst case scenario, if you pay it, it could be boot. Defeasance. Defeasance is a situation where the loan is not going away. It's that you're substituting different collateral for the loan that the lender is releasing from the sold property, the relinquished property, but there's other collateral that's being put up to satisfy eventually the obligations of the loan. Defeasance can create some problems. Todd, if I give you a bucket full of money and then you buy treasury bonds and pledge those treasury bonds as substitute collateral, you've received cash, you now hold treasury bonds, that's all boot, arguably. So you got to be careful in these defeasance arrangements, not to take a bunch of cash in. That's going to trigger gain. The receipt of cash is taxable. You don't want to have that. How do you fund a holdback? I've got a client that owns land, and the land has a bunch of debris and junk on it. And the buyer doesn't want to take the property with all this debris and junk. So they're requiring the seller, the taxpayer, to escrow a whole bunch of money to assure the buyer that the junk is going to be removed, the debris is going to be taken away. Well, the tax attorney for the client said, you can escrow money, but escrow money out of your own pocket. Don't escrow money out of the sale proceeds, because we want to have all of your exchange funds immediately available for redeployment, because we're already closing on the replacement property before this debris could be removed and the escrow would be broken. So whenever possible, if you've got holdbacks, escrows on the sale of the relinquished property, if you can fund those out of pocket rather than out of sale proceeds, you're going to alleviate the logistical difficulty of what do you do with that cash when the escrow breaks? And if it breaks after you've completed the exchange, you missed the train. You don't have an opportunity to reinvest this surplus cash into the replacement property. There's a lot of authorities for what Todd and I have talked about today. And in preparing for this seminar, of course, we reviewed the code section 1031. We've reviewed the Treasury regulations. There is a new reg for 1031A3 that has been released that talks about the 15% incidental value of personal property that may be received in conjunction with the completion of an exchange. And then going way back to the 70s, there's a really good revenue ruling, 72-456, that is sort of the gold standard for understanding how commissions and other transactional expenses can affect a 1031. And all of it kind of just fits together with the overall premises that we talked about: not cashing out, reinvesting your equity into properties of equivalent or greater value, offsetting your debt relief, redeploying your radioactive cash into the new property. These big overarching concepts are played out in more detail in examples that you will find in the Treasury regulations and in this revenue ruling. If you want to know more about this, you can give us a call. I'm always happy to collaborate about new potential exchange transactions when our company is going to be engaged as an intermediary. And Todd, in his capacity as a tax advisor, I think can also be brought in to confer on really complicated and interesting stuff.
Well, we've done some fun ones over the years, Jeff, haven't we?
We have. It's the fun ones that make it interesting, but it's the small, consistent little ones that pay the light bill and keep the operation afloat. So I like them all, but I do like to get under the hood and collaborate with other CPAs, attorneys, and tax strategy people that are looking to help people maximize the tax efficiency of an exchange. And I just want to make a mention. If you're selling a business that also has land and buildings, you are going to want to allocate in the purchase agreement the highest value to the land and buildings and the lowest value to the other stuff. The other stuff is personal property that we can't work the 1031 magic on. And you may have very low basis in that other stuff because there's been some very rapid depreciation that's been available. And in some situations, it can make a big difference, because if you're selling your business, let's say you're selling a trucking business, after paying the bank back and then paying the taxes on your recapture of depreciation, you may not have much to show for your 30 years of running a trucking business. You know what I mean? So you got to think about how do you maximize what you keep? How do you maximize the tax efficiency of your transaction and make sure that you have enough cash left over to reinvest into something that's going to give you a steady, reliable stream of income in your retirement years? And you can utilize 1031 exchange to redeploy into real estate investments that will generate a steady, reliable stream of income. But you got to keep your powder dry. You got to keep that equity available for redeployment. Otherwise, it may not make sense to sell your business.
Yeah, the lucky thing is, and the real estate people on here know this, cap rates create a lot more value on income than multiples on operating businesses. So like if at the Real Estate Journal, we buy another publication, we're paying 3 to 4 times EBITDA, which is like NOI. It's, roughly the same. You at a 5 cap though, that's 20 times the equivalent of EBITDA or NOI, right? So you can allocate a lot more to real estate because it's actually accurate. Not, aside from the tax reasons to want to do it. Hey, I got to bring up one thing, Jeff, before we get off the line. When you and I first met, I was in my 20s. You were probably 18 or something because you still look younger than me. But I had just written a paper on 3 code sections that every real estate person needs to know. Obviously, 1031 is the first one, right? You need to understand this. You need to do it right. It's a big part of your business. But the other one you brought up, and I couldn't think of it off the top of my head, so I had to look, and that's code section 453 for the treatment of debt. Okay, so that one deals with installment sales, but basically getting cash in from borrowing is not a taxable event in most scenarios. So being smart about that and proactive about that, it can really mess up your 1031 exchange, or it can really be a home run if you do it after your 10. It's not part of the 1031, it's part of your normal strategy. So I have a client that loves to say $1 borrowed is $1 earned. It's not untrue, right? It's just as sort of flippant as that sounds, or maybe reckless. I think he means that it's reckless, but from a tax perspective, it's a very good strategy to not forget amongst all this. But if you do it wrong and it shows up in your closing statement in the wrong way, you can create issues, right? So I'll let you recap, and we're a little bit over time, but again, this is on YouTube, so you can watch the whole thing in its entirety and enjoy.
Well, I just want to emphasize again that this presentation is for pedagogical or informational purposes only, and it should not be intended or constitute tax or legal advice. No attorney-client relationship has been created by this communication. But if you do want to talk about a potential transaction and you want to confer with us, you can reach out to us. My information is here on the slide, and I'm happy to confer with you.
And my email address is top secret, so we'll keep that off the screen. I'm only kidding.
Todd, thank you.
been very informative. I hope everybody enjoyed it. Again, looks like we got everybody logged in and logged out that needed CE credit, or they got their numbers. The questions were answered. So Caitlin, if you're still on, we'll get those CEs uploaded for everybody, and happy summer. Hope you're enjoying everything. Thanks, Jeff.
Thank you.